Black swan events are basically improbable and unexpected events which are difficult to predict and plan for. This is mainly because they are unusual and outside the normal. Some examples of such events that occurred in the past are the Black Monday of 1987, the global financial crisis of 2008, and the market sell-off in the beginning of 2020. Nassim Taleb, the author of the best-selling book The Black Swan, has done very well by writing and explaining about such events which occur every now and then. And when they do, they create huge disruptions in the financial markets, especially to those who are not prepared for them. Being an experienced options and derivatives trader who spent years doing that, Nassim Taleb has developed a deep understanding about Black Swan events and how to greatly benefit from them. One of the hedge funds that Nassim Taleb was an advisor for and which followed a similar investment strategy to what Nassim Taleb suggests made over 4,000% return when the markets went significantly down in the beginning of 2020. So in this video, we will dive deeper into that and go through Nassim Taleb's investment strategy in order for us to figure out exactly how to greatly benefit when a Black Swan event happens, instead of getting completely wiped out because of it, like unfortunately many other investors. So without further ado, let's get started.
It took me another 30 years to figure out something I told you, that unless you're hedged for a portfolio, unless you're hedged for events like Black Monday, whatever alpha, you think you're gonna get, you're not gonna get it. Because what happens is that if you go bust on that day, there's no alpha.
Nassim Taleb says that when it comes to predicting the unpredictable, grandmothers usually do better than many scientists and experts in this field. This is mainly because the traditional models that are taught in schools like the bell curve and the Black-Scholes model don't really work, especially in the financial markets. Nassim says that these models with thin tails on the sides cause us to underestimate the probability of extreme events happening in the future, like a Black Swan event for example, which are more frequent than we think. And once they do happen, they wipe out many investors and traders out of the game completely, because they weren't taking these events into account when it comes to managing the risk in their investments. For example, the normal and the average annual return for the S&P 500, which is the most prominent index used to measure the performance of the stock market, is around 10% per year. However, when a Black Swan event happens, like a Black Monday for example, when the market went down by 22.6% in a single day, many investors lost a lot of money, including all the profits that they made during the time when everything was okay and normal. So basically, many investors enter the market at its peak or when everything is normal, and then they exit the market when the prices have fallen down significantly due to a Black Swan event, either because they are panicking or because they need the money to pay for their bills. And that's why many people do not even get the average return of the S&P 500 of around 10% per year. In one of his interviews, Nassim Taleb mentions the story of someone who accumulated millions of dollars in the markets in 8 years, and then he lost it all in 8 minutes when the markets opened due to a Black Swan event. That's why Nassim Taleb advises people to be more aware of such events, especially by managing their tail risk. He says that not only the average investors get caught by Black Swan events, but even more experienced investors and large banks as well, like what we saw happening back in the global financial crisis of 2008. The main difference between the average investor, a small bank, and a large bank is that the large bank gets bailed out by the Fed and the government, because they are simply considered too big to fail. The definition of too big to fail has been changed earlier in 2018 to only include the banks with at least $250 billion in assets, which makes a list of around 13 banks. We actually saw that happening very recently with smaller banks like First Republic and SVB Bank, where they were not bailed out by the Fed because they are not considered to be too big to fail. So basically, even banks and a lot of hedge funds who are considered experts in this field also downplay the importance of properly hedging against Black Swan events, and therefore they go completely bankrupt. So what is the solution, and how is it possible to hedge against such disastrous and unpredictable events according to Nassim Taleb? Nassim says that tail risk management in the form of what he calls a barbell strategy is the best way to hedge against Black Swan events for the majority of investors. This strategy implies having a small portion of an investment portfolio in very high risk, high reward investments, while at the same time having a large chunk of the portfolio in very safe and less volatile investments. So something like having 10 to 15% in stocks, options, startups, or any other asset class with high expected returns, while having the rest of the portfolio in very safe investments like gold or even cash. And also at the same time having nothing in medium risk, medium rewards investments in between. And that's why this strategy is called the barbell strategy. The 10 to 15% exposure to high reward assets will pay off when the market is bullish, and the 85 to 90% in ultra safe assets is meant to not be affected in case of a black swan event happening. Sometimes this strategy implies losing a little bit of money each year when the market is bullish, but when a black swan event takes place, the investment portfolio makes huge gains and covers all the losses from previous years. In fact, Universa Hedge Fund, which followed a similar investment strategy, made more than 4,000% return when the market went significantly down in the beginning of 2020. Mark Spitznagel, who is the CEO of that hedge fund, said that he had to wait 12 years for this to happen. According to the strategy, a small loss is a good loss, and in this way, he managed to build what's so-called a doomsday machine, where his fund makes huge profits when the markets are panicking because of a black swan event. Other more traditional ways to mitigate risks that are usually suggested are simple strategies like diversification and ongoing monitoring, which also are some ways to consider. But according to Nassim Taleb, tail risk hedging is a must because any trader or investor who has even a little bit of tail risk in their strategy will get wiped out over the long run.
If I have a tiny probability of ruin, I would be ruined. It's not like an option. Over time, you lengthen the time. So the way people look at risk is wrong. The way you got to look at risk is, if you're going to do this for the rest of your life, by how much is it going to shorten your life expectancy? Okay, that's the way to do it, you see? Or what's your expected life expectancy if you do this?
So understanding how to mitigate risk by either diversifying and making uncorrelated bets or by following what Nassim Taleb suggests when it comes to tail risk hedging is crucial to stay in the game for the long run and to not get caught up by unpredictable black swan events, which seem to happen more frequently than what the majority of investors think. But that was it for this video. If you enjoyed it, make sure to leave a thumbs up and to subscribe to the channel for more videos like this. And with that being said, see you in the next one.